Hello, I'm Sean Richards of Not a Yes Man's Economics, and today it's the euro area in Europe that's in focus. Why? Well, because this morning we've had money supply data out of the European Central Bank. For those that haven't been following events, in 2018 the euro area economy slowed down quite a lot. Just to give you an idea, quarterly economic growth slowed from approximately 0.7% to 0.2%. So from what was called robust growth to slow, weak, whatever you want to call that. However, the point of issue at today is that we got a signal of this, what in economics we call a leading indicator, which was the money supply numbers, in particular narrow money. This is of importance this morning because we've seen another slowing. What I mean by that is M1, which is the narrow money supply measure in Europe, annual rate of growth has gone from 6.6% to 6.2%, so another decline. Just to give you an idea of the picture, in the summer of 2015, when all of the monetary stimulus policies were pumping things up, the annual rate of growth got to 11.7%. It had another peak in the summer late period of 2017 when it went to 9.7%. So as you can see, there's been quite a decline. And what this then led to was a slowdown in the euro area economy. It's a type of monetarism, if you want to use an old phrase. And it's worked really well in 2018. Not good for the economy, excuse me for that part, but in terms of predicting a weakening. And we've seen more today. This provokes a few thoughts because already there are problems for the euro area, the way things have slowed up. For example, the German economy actually contracted in the second half of 2018. Italy was already in recession at the end of last year, now looks like it's declining further. So quite a few questions are posed if, looking at these numbers, the outlook for the first half of 2019 doesn't look very good either. Another way of looking at these sort of things is to move to the wider or broad money measure. That doesn't work so well in the short term and tends to look about 2 years ahead. But we see a similar pattern here. The annual rate of growth went from 4.1% to 3.8%. So again, a slowing, suggesting that further out we're going to see weakness too. There are various particular factors in this. I've already talked about M1 slowing, but actually that would have led it to be a higher rate than it is now. It was the wider lending measures that pulled it down. And an example of this would be lending to businesses, which people had quoted as being a strong number, which to some extent it had been, but that fell from an annual rate of 3.9 to 3.3%. So these numbers have worked well, look like they will filter into the economy. How does this operate? Weaker economic growth we can expect. In some combination, this feeds in with inflation looking further ahead. We don't know what inflation will be then, but it looks like the trend for that will be pulled down either in some combination with growth. Another way of looking at this is to move to house prices, which are kept out of the inflation numbers in the euro area. Why? Well, because they're growing faster and it'd be rather inconvenient, wouldn't it, to put them in, as it would make people think that they're worse off, which they are. So if we look at that at 4.3%, and for example, one of the areas leading in this area, the Netherlands, published numbers nearly 9%, 8.7%, we can see we probably expect house price growth to slow now. That tends to go with broad money growth rather than the narrow money aspect. So the thought for today, as we look ahead, is that things look unlikely to change much in terms of weak economic growth in the euro area. And something that its central bank has been pleased about, house price growth, we may over the next 6 to 12 months see a bit of a dip in that as well. So in response, I expect the European Central Bank to ease policy further. There might be what they call extraordinary monetary measures to do this, and I would think that they would start for that for the simple reason that their deposit rate, you see, is already minus 0.4%. So there'll not be any rush to take that even further into negative territory. So not an entirely optimistic outlook, I'm afraid, but things are what they are, reality is what it is, and it's better to accommodate that, I think. Thank you.